Good evening. This is my homework assignment. This week is financial market effects on industry, and I picked risk and return. What is risk? When you invest, you make choices about what to do with your financial assets. Risk is any uncertainty with respect to your investments that has the potential to negatively affect your financial welfare. For example, your investment value may rise or fall because of market conditions, which is a market risk. Corporate decisions such as whether to expand in a new area of business or merge with another company can affect the value of your investments. That's an example of business risk. If you own an international investment events within that country can affect your investment. So those are examples of political risk and currency risk. There are other types of risk. How easy or hard it is to cash out an investment when you need to is called liquidity. I hate that word, risk. Another risk factor is tied to how many or how few investments you hold. Generally speaking, the more financial eggs you have in one basket, say all your money is in a single stock, the greater the risk you take, which is concentration risk. In short, risk is the possibility that a negative financial outcome that matters to you might occur. Risk and return considerations. Risk refers to the variability of possible returns associated with given investment. Risk, along with the return, is a major consideration in capital budgeting decisions. The firm must compare the expected return from a given investment with the risk associated with it. Higher levels of return are required to compensate for increased levels of risk. In other words, the higher the risk undertaken, the more ample the return, and conversely, the lower the risk, the more modest the return. The risk and return trade-off is also known as the risk and return spectrum. There are various classes of possible investments, each with their own positions on the overall risk and return spectrum. The general progression is short-term debt, long-term debt, property, high-yield debt, and equity. The existence of risk causes the needs to incur a number of expenses. For example, the more risky the investment, the more time and effort is usually required to obtain information about it and monitor its progress. Moreover, the importance of a loss of X amount of value can be greater than the importance of a gain of X amount of value. So a riskier investment will attract a higher risk premium, even if the forecasted return is the same as upon a less risky investment. Risk is therefore something that must be compensated for, and the more risk, the more compensation is required. Examples of risk and return. An example of an investment with low risk would be the United States Treasury bonds. Treasury bonds are one of the most stable investments available. Treasury bonds are offered by the United States government with their full faith and credit. What the full faith and credit statement means to the investor is that the U.S. government backs these bonds and is generally accepted that the government will never default on its loans. For this reason, given the low risk, Treasury bonds have a low return on investment. Conversely, an investment with a greater risk and potentially higher rate of return in an investment is biotechnology stocks. Biotechnology investments have more risk as the technology involves many new experimental drugs and treatments. The creating of new drugs and treatments is expensive monetary and time investment for the biotech companies and is prone to a high level of risk. According to Investopedia, traditionally between 85 and 90% of all new experimental drugs will fail, and not surprisingly, most biotech stocks will also eventually fail. Although biotech stocks have a higher risk than treasury bonds, all it takes is one successful biotech investment to result in massive returns. Therefore, when investing in it, again comes down to risk versus reward, or the return. Each investor must analyze their future investment to gauge the potential of the risk and reward. So how do you apply the risk? As an investor, it's important to understand the concept of risk versus return. With clear understanding of risk and reward, you can select the investments for your portfolio that provide you with a comfortable level of risk and return. Understanding risk and return will allow an investor to create a portfolio that is diversified. Diversification of a portfolio is a strategic way of investing which allows the spread of risk of investment amongst many stocks and bonds. Proper diversification involves understanding the investor's long-term goals and risk level, and then weighing that against the desired level of return. To achieve their goals before investing in stocks and bonds, investors must understand what exactly they're investing into and know their tolerance level for risk. Some investors are in the market for a fast, high-risk return, while others are more comfortable with a long-term, steady investment approach. The only wrong investment option is the one that makes the investor feel outside their comfort zone. Past performance of investments is a clear indication of potential future results. However, past performance is not a guarantee of future results. Because of this, each investor must analyze and evaluate for themselves the potential risks and rewards of each investment. So some of the ethical issues as well. An ethical issue with this concept can be that the portfolio managers are not given the right information on risk and return. And this can be addressed through understanding how risk and return of a portfolio is calculated and doing our analysis before investing. References.